seeing the Dow in negative territory. The S&P 500 is higher by about 0.2%, and the Nasdaq, that's up by about 0.3%. A record-breaking rally for major indices this year, and a lot of that is thanks to artificial intelligence. The chip stocks accounting for 36% of S&P 500 gains so far in 2024. Our next guest thinks that investors should be exposed to the AI trade ahead of potential turbulence this year. To discuss, let's bring in Roosevelt Bowman, who is the Bernstein Private Wealth Management Senior Investment Strategist, here with us live in living color in studio. Great to see you in person.
Thank you, Brad. I appreciate it.
Absolutely. So let's talk about some of the strategy coming off of the first half, where, as we mentioned, the major theme was really generative AI. Yep. And now, as we face the back half of this year and commence that, it's really this focus around, okay, what's the outsized event that could move markets, whether that's a Fed policy move that finally signals what the rate cutting cycle could look like, or whether that be an election type move. How are you kind of anticipating what those factors may be and the correct portfolio positioning going into these events?
Yes, I think starting with the Fed, right, and kind of expectations for where rates will go. I mean, in our eyes, we're looking for a cut at the end of the year in December. Markets are pricing about a 75% chance of a cut in September. That's probably too soon. Mm-hmm. It's possible, but really you would need weakness in inflation and the labor market to all line up. If any of those kind of fall the wrong way, then you end up with a cut being pushed to December. So I think the Fed is less of a story. I do think one of the other major factors, in addition to generative AI, does deal with the path of Fed policy, which is that they really moved to the sidelines in the fourth quarter of last year. So that pushed down interest rate volatility. That really produced a really supportive environment for risky assets, stocks included. So I think that's the other major factor. I think both will still be important in the second half of the year. You mentioned major events. Obviously, everyone is focused on the election. I think there's two parts of that. One, the kind of election-generated volatility. When you look historically over the past 35 years, it's about a 6-week span. Mm-hmm. So for us as strategists, advisors to our clients, we don't want to emphasize 6 weeks when thinking about a long-term plan. The other major question that's come up, of course, is the debt, right? How much we're borrowing in the US and the concerns about that potentially pushing in interest rates much higher. I think our view is we're less focused on this acute event where rates explode higher, but more thinking about the potential for growth to be a little bit lower in the future because you're taking a lot of those tax receipts in to just pay off your creditors if they're the U.S. government.
That's an interesting point on growth, and I'll kind of preface my next question on growth with this. According to some FactSet data for the second quarter of 2024, as we're about to kick off that earnings season here, the estimated year-over-year earnings growth rate for the S&P 500, 8.8%. And if that's the actual growth rate for the quarter, it's going to mark the highest year-over-year earnings growth rate reported by the index since Q1 of 2022. You hear stats like that. What does that set up for the growth trajectory ahead, as you were talking about where we could potentially see some pockets of slower growth?
Yeah, I think over the near term, we're probably looking at earnings growth that, in our eyes, a little bit slower than that, right. Not materially, but still supportive. I think what we're following is a couple of trends. When you look at the consumer and some of the, I would say, downshifting, if you will, in the quality of goods in certain consumer sectors, and you're also thinking about purchasing power. And so right now, that's been strong for the most part over the past, 18 months or so, because wages have kept up. But when you kind of look at the savings rate, that's only about 60% of the 20-year average. When you look at wages still firm but slowing a bit, it does leave that opportunity, that room for consumers to potentially pull back, and that kind of leads to our forecast of slower growth in the second part of the year.
Where are the opportunities right now, specifically as you think about some of the other asset classes, whether that be global private credit or real estate debt or real estate equity? Where are those kind of pickable pieces of other asset classes that investors can chart some type of entry point at this juncture?
I think those are three that we've been really focused on with our clients. I mean, primarily because of the fact that interest rates went up so much over a short period of time in 2022, you ended up with this dislocation. Mm-hmm. If you think about private markets and kind of limited partners and essentially their asset allocations being tilted the wrong way, all of a sudden their private assets are a much bigger portion of their portfolio than their public assets because the stocks and bonds came under massive pressure in 2022. So that's forcing some of them to kind of have to divest faster than they want. That presents a great opportunity for us. I think it's a similar story with banks. If you're a bank and maybe you have some loans that aren't performing well, and you have to get them off your balance sheet, well, we're not a bank at Bernstein. That's great. That's an opportunity for us to buy some assets cheaply, whether you're talking about global private credit or commercial real estate as well.
All right, we got to leave things there. Roosevelt, we'll end on a fun note. Which Olympic event you're going to be watching in the next couple weeks here?
Oh, it has to be basketball.
Okay.
But I'm just hoping my Lakers don't get hurt.
There you go. You got a few of them out there competing here. Roosevelt Bowman, who is the Bernstein Private Wealth Management Senior Investment Strategist, joining us here in studio. Thanks so much for the time.
Thanks, Brad. Appreciate it.